Hello, everyone. This is Sebastian McMahon from IA Financial Group. As you can see, I'm on the road this week, but it's no excuse to not update you on the week that we just had. So the week ending June 17, 2022. So let's start with a look at the markets at the close on Thursday. So you have red, then you have more red, and then you have even more red. So interest rates higher on the week. The Fed came out with a 75 basis points hike, of course, that caused higher rates, but also lots of volatility. So on a Thursday, the volatility, so the range between the minimum and the maximum on the day for the 10-year rate in the US was 30 basis points. So we're at almost historical levels here. So quite a lot of things going on. So continuation of the bear market. We had a bear market rally that ended last week. After that, with inflation being strong, the Fed hiking 75 basis points. So that weighed, of course, on the stock market. And we're seeing indiscriminate selling right now. So even though the TSX is in better shape, we have energy, we have materials, we have the financials that are all in good shape. I mean, everyone's just selling equities right now. So you have minus 6% for the TSX and the S&P 500. EFI and emerging markets were a bit less negative, but still very painful weeks. Are we due for a bit of a rebound? Maybe. I mean, we could be in for a bear market rally. It's hard to tell exactly until you've seen a few days and you've seen the market action. But a lot of damage over the last 10 days. The damage over the last 10 days, I mean, it seems to be astronomical. So in the last 7 days, rather, we had more than 10% negative, and we've seen that multiple times in history. It's not a one-time event. Typically 12 months, 24 months forward, you have huge positive returns, but in the short term, you can have anything. So I would advise against trying, to grab a falling knife here. Price of oil down, USD CAD down, so the Canadian dollar is at least shielding some of the losses from foreign investments, and gold is still looking for a direction this year. So start with maybe a first slide here. So it's the same slide as last week, except I updated the chart on the right, which is the expectations from the Atlanta Fed GDP Now model. So it's a forecasting model that they take all of the new data that comes out. And this week we had the retail sales figure in the US that was let down. So revised lower their expectations for Q2 growth to 0%. So we had negative growth in Q1, and now we're looking at nothing in Q2 with a downward trend on these revisions. So maybe we're already in a technical recession. Technical recession, again, is 2 consecutive quarters of negative growth. Technical in the sense that we might not have, I don't think we'll have a strong rise in unemployment because of the labor shortage issues. The bar is pretty high for businesses to start, massive layoffs. So a technical recession is something that is very likely that we're already in. So this is very important because next slide here, the Fed hiked 75 basis points. So it's 3 hikes in one during a bear market. So it's one of the, I think it's the first time ever that we see a Fed rate hike during a bear market, and we had the historical one. And we might already be in a recession. So a very interesting juncture that we have right now. So the rate went from 1 to 175, the leading rate in the US. But here, what I thought I'd bring was the forecasts from the Fed. So you have GDP, you have unemployment, and then you have inflation. So as you can see now with this hike, the Fed is coming out saying, well, here's our forecast. So they're expecting very low growth for GDP in 2022 and 2023. When you say 1.7%, that's below long-term trend. And they're saying that unemployment should rise from 3.5, 3.6 right now all the way to 4.1 by 2024. And inflation is going to stay sticky this year, will fall down, but still at elevated levels next year. So they're pretty much saying that the economy is on a slowdown path. There's not much that they can do about inflation right now, and their hiking probably will hurt the economy some more. So not a very bullish picture. So that brings us to the markets now. If you look at these charts here, those are some survey data from institutional investors. As you can see on the left, institutional players are very downbeat on the global growth prospects, and on the right, the prospects for earnings growth. And I think that's the key point. Since the beginning of this year, this pullback in the market was almost 100% about valuations falling down, so multiples, so price earnings. So people are just willing to pay less for every dollar of earnings on the S&P 500. But now the next leg probably is going to be that, well, the expected earnings will have to come down. So that's going to be probably a more painful part of the drawdown. So earnings are expected to grow by 10, 15, 20% in the next 12 months. I think it's unlikely. So if you look at the behavior of the stock market, so now we're at minus 23.55. That was as of the close on Thursday. So let's see what happens on Friday. So when you listen to this, probably the day will be done, but I'm recording before market opens. We're looking for positive day, slightly positive. So we'll see where we end up. But a bear market like we're in right now, we've been in this one for 5 months. So it started in early January. So now it's confirmed that it's a bear market, but you need to go back to the day that we hit the peak on the stock market. That was on January 3rd. So now we're 5 months in. The average bear market lasts 11 months, and the median one lasts 8 months. So we might be just halfway through in terms of time, in terms of drawdown. If we go to the average, probably we're 2/3 of the way through, but there might be some more ways to go. So last chart here. So if there's a recession or there isn't a recession, it matters, I mean, still quite a bit for the markets, because if there's no recession, then that's the historical bear market. Without a recession, you get the gray line is this chart here. You can see it's less deep. You have a few stronger rallies in there, and maybe you're up to the races a bit quicker than if there is a recession. This is the black line, the historical behavior of bear markets when there's a recession. So you have a few more dips, and the dips are more painful. So again, we think that we might already be in a recession in the US, but those are, not recessions like 2020 and 2008. So does that make a difference? We'll keep you posted, but I think being patient here, using the rebounds in the markets to rebalance, maybe to sell some positions that went well, and not try to catch a falling knife. That could be a very winning strategy in this kind of environment. So I just wanted to share a few historical charts here. So next week we'll have inflation in Canada, so maybe more speak about what the Bank of Canada is going to do. So that could be an important one. Retail sales, and in the US, of course, consumer confidence. Last time we had a reading, we're at the 70-year low, so the lowest since the 1950s. Let's see if we stick there, if there's any update to that. So that wraps it up for the week. ia.ca/economy is your go-to webpage. There's new Economy and Finance 101 content that's been posted recently, and we're working on some new ones, so we should be recording next week. So you'll have that in a couple of weeks. And you can always follow me on Twitter and on LinkedIn. If you want to have a PDF copy of this presentation here, you can find it on LinkedIn. So that wraps it up. Always happy to be here to help you guys. Next week, because of the holiday in Quebec on June 24th, I should be recording and posting this on a Thursday rather than a Friday. So thanks, have a good weekend, and I'll see you again next week.